I'm Steve Quinn. In this presentation, Ashley and I will speak about the client-focused reforms to National Instrument 31103, or CFRs. Ashley and I are both analysts with the Registrant Oversight Group at the ASC, and among other work, conduct reviews of firms to ensure compliance with securities legislation, including the CFRs. If you have questions about this presentation or the CFRs in general, please submit them through the Q&A tab in Zoom. Your questions will be addressed time permitting during the Q&A session that follows this presentation. Here's a look at the presentation agenda. We decided to focus on areas that we believe are particularly important to our registrant population. I will speak to the CFRs in relation to proprietary products, and Ashley will speak to the CFRs in relation to costs, charges and fees, relationship disclosure information, and misleading communications. We know from our reviews that most of the registrant population in Alberta sells or manages proprietary products. For this reason, I'll cover the CFR amendments to KYC, KYP, suitability, and conflicts in relation to proprietary products, starting with KYC. The CFRs specify a list of factors that firms must collect to obtain adequate KYC information. This list of factors is a prescribed list. However, the depth of questioning and level of detail required will vary, so a firm should tailor its KYC process to reflect its business model and the securities and services it offers to clients. For example, exempt market securities, including proprietary products, are generally illiquid and higher risk. As such, we generally expect EMDs to collect specific information about a client's financial circumstances, including investments held elsewhere, including exempt market products, and the risk profile of these investments. This information may be needed to sufficiently support the suitability determination and assess whether the trade is within the limits of the exemption being used. Not collecting this information is a common issue that we see in compliance reviews. However, it's important that a firm collect this information to ensure that the investment does not lead a client to be over-concentrated in a single issuer or related issuer group, or a specific sector or geographic area. In some cases, we have heard from firms that clients may not want to share the details of all of their investments. This does not automatically prevent the firm from servicing the client. However, the firm will need to use professional judgment. Firms should collect enough information about outside investments to the extent that such information is needed to support the suitability determination. Another common issue that we see is where a firm has recommended a high-risk proprietary product to a client with a medium-risk profile. Firms should have a process in place for assessing the client's risk profile, such as assessing the client's willingness to accept risk and their ability to endure potential financial losses. If it's determined that the client does not have the capacity or tolerance to take on the potential losses or volatility associated with the high-risk product, the firm should explain to the client that their need or expectation for a higher return cannot be met, and as a result, the high-risk product is unsuitable. The CFRs introduce a new section for KYP that codifies previous CSA guidance and clarifies what was previously considered to be an implicit compliance obligation. When a firm offers proprietary and non-proprietary products, we expect that the proprietary products will be subject to the same KYP process as non-proprietary products. For example, to comply with the new KYP requirements, firms must undertake their own product assessments, independent of any that may be done by the issuer. Firms should have a robust KYP process for proprietary products. To be clear, the KYP standard must be met for all products, but with the CFR amendments, firms that sell or recommend proprietary products will need to do additional KYP work, such as addressing the inherent conflicts of interest that are almost always material in this type of business model. We'll discuss these conflicts shortly. Similar to the KYC process, the KYP process may vary depending on the business model and types of securities and services offered. We expect firms to document how proprietary product fits within its business model and strategy. Firms should also document how proprietary products are aligned with clients' interests, including why the firm decided to recommend proprietary products over non-proprietary products. We expect that firms will consider the factors listed in this slide before approving the proprietary product for a shelf. For example, for a private real estate fund, we suggest that a product comparison be made with publicly traded real estate products like REITs. For pooled funds that are only available to a firm's clients, we suggest a comparison to mutual funds and exchange-traded funds. Firms should weigh the costs and benefits of the advantages and disadvantages of proprietary and non-proprietary products. For example, are the potentially higher distributions of private real estate funds compared to publicly traded REITs enough to outweigh the drawbacks of limited redemption opportunities? Does the proprietary product have a competitive fee structure and past performance when compared to similar products available through other registrants? If not, the firm may need to consider making changes to its proprietary product before it distributes or recommends it. When assessing the fees and costs of proprietary products, all direct and indirect compensation arrangements, including related party ownership, ongoing commissions, and other issuer payments and agreements need to be considered. And do the material conflicts and risks associated with the product require the firm to implement specific controls, such as maximum concentration thresholds for certain types of clients, or perhaps minimum risk requirements, such as only selling a certain product to investors with a high risk tolerance. The CFRs also introduce a requirement that an action subject to a suitability determination must put the client's interest first. This means that the interests of the client are paramount, and that a firm and its registered individuals must put those interests ahead of their own interests and any other competing considerations. The fact that a recommendation or other investment action is suitable is not enough to meet the suitability obligation, because a firm must also determine whether that action puts the client's interest first. This would require firms to not make a self-interested choice when recommending a product or security. The CFRs introduce a list of factors that firms must base their suitability determination on. Each factor may not be equally applicable to every suitability determination depending on the securities and services offered. However, we expect firms to use professional judgment to determine the weight of each factor when making a suitability determination. Some of the factors to consider when making a suitability determination are included in this slide. For example, firms should consider the same factors considered as part of the KYP process when determining whether a client's KYC information, including investment objectives, time horizon, and risk profile, is good fit for the product being considered. A common issue that we see is that firms do not evidence an adequate assessment of the impact of concentration risk in liquid securities held within and outside the firm. Determining and adequately demonstrating that a trade or a recommendation puts the client's interest first is particularly important when clients reach high concentration thresholds and the recommendation would result in a significant increase in the risk associated with the client's investment portfolio. The firm must ensure that it can evidence how higher concentrations in proprietary products are putting the client's interest first and are not being recommended by the firm to earn additional commissions or fees. With respect to a reasonable range of alternative actions, we mean that the firm should consider alternative products on the firm's shelf. When assessing suitability in this regard, firms must put the client's interest first and not prioritize incentives such as commissions and trailer fees. There may be cases when a firm's shelf is limited or the firm only sells one proprietary product. If these firms cannot determine that their recommendation will put clients' interests first, and there are no alternative investment actions that the firm can recommend and put clients' interests first, then they will need to revise the proposed trade or potentially turn down the client. Another consideration is that the new CFR client-directed trade requirements require firms to recommend to a client an alternative action that is suitable and puts the client's interest first. In cases where the firm does not have alternatives to recommend that meet the CFR suitability requirements, we expect the client will be advised that the alternative is to not proceed with the trade or investment action. The CFRs introduce a best interest standard to managing conflicts of interest. This means that the client's interests have higher priority than the interests of any other parties, including the firm and its registered individuals. In turn, this means that all material conflicts must either be avoided or addressed, keeping the best interests of the client in mind. This is a principles-based approach and will vary depending on the specific facts and circumstances. One important distinction between the CFRs and prior requirements in 31103 is that solely providing disclosure and obtaining a client's acknowledgement of a material conflict of interest will not be sufficient. Firms must take steps to avoid material conflicts or address material conflicts in the best interest of clients. Disclosure is one of the controls that can be adopted, but in conjunction with other controls. There is an inherent conflict of interest when a firm trades in or recommends proprietary products, and this conflict is almost always a material conflict of interest. There are several factors that increase the materiality of conflicts when trading in or recommending proprietary products in comparison to similar non-proprietary products. For example, proprietary products that have higher fees and costs, which are directly or indirectly benefiting the registrant and its related parties, incentivize the sale of such products. Incentives are also created from having higher sales commissions and ongoing fees for selling, managing, or promoting proprietary products over similar non-proprietary products. Ashley will cover this point in more detail in a few minutes. An example of a non-monetary benefit is when a dealing representative's promotion is dependent on the sale of proprietary products. For conflicts that the firm chooses not to avoid or cannot avoid, how can such conflicts be managed? The companion policy to 31103 provides several examples of management. In the context of proprietary products, this slide shows 4 effective management techniques. 1, having the same robust KYP due diligence process as for non-proprietary products. 2, making non-proprietary products available on the firm's shelf. 3, limiting monetary and non-monetary benefits that could bias recommendations toward proprietary products. For example, we have seen where a firm will earn a commission on the sale of a proprietary product that is equal to or less than the commission earned on a non-proprietary product. We have also seen where the proprietary product offered by the firm does not have trailing or ongoing fees. A 4th technique is to use robust supervisory and compliance controls. For example, overseeing and analyzing trading patterns to identify if certain registered individuals are recommending proprietary products more frequently. Compliance staff can make investor calls to assess the quality of a registered individual's sales and suitability practices. And negative consequences can be implemented, such as reducing commission grid payouts for individuals who receive valid complaints. As a presentation in respect of proprietary products, Ashley will now speak about the CFRs in relation to costs, charges and fees, relationship disclosure information, and misleading communications.
Thank you, Steve. The CFRs introduce KYP and suitability requirements where firms and registered individuals must take reasonable steps to assess the relevant aspect of the securities they sell or recommend, such as the initial and ongoing costs of acquiring, owning, and disposing of the securities, as well as the potential and actual impact of those costs on the performance and on the client's return. For example, firms may receive an upfront sales commission on the sale of the product, as well as an annual trailing fee from the issuer. The product may also have redemption fee or a penalty if the client redeems before the anniversary date. This also includes investment fund management fees and other ongoing fees the client may incur in connection with a product or service provided by the firm, such as fees that are not charged directly to the client, but are taken from the fund as a percentage of its total assets, or fees that will be deducted from the returns of the funds, which affects the client's returns on their investment. These initial and ongoing costs should be included in the KYP and suitability assessment, as well as disclosed to the client prior to accepting an instruction from a client to purchase or sell a security in a non-managed account, because they have an impact on the client as they can reduce the client's return on investment. When a firm determines whether an investment is suitable for the client, the firm must also consider the potential and actual impact of the costs on the client's return on investment. The initial and ongoing costs would include all direct and indirect costs, fees, commissions, and charges, including trailing commissions and any other kind of direct or indirect compensation which may be associated with a client transaction or a firm making a decision for a client's managed account. The CFRs also introduced the new concept of an investment action, and firms are expected to make a suitability determination before taking any type of investment action for their clients. In addition to the trade-based investment actions, the guidance in 31103 CP confirms that an investment action also includes opening a client account. Because of this, when a firm is opening an account, we expect the firm to explain the features and associated costs of different types of accounts that are available to the client, such as fee-based and commission-based accounts, and recommend the type of account that puts the client's interest first. These costs can have a significant impact on the client's return over time. Therefore, the suitability determination of the appropriate account type should be made prior to opening of the account. In some circumstances, for example, when a client's circumstances change significantly, such as when someone retires, we expect the firm to determine whether the account type needs to be reassessed to ensure it continues to be suitable and put the client's interest first. Firms should assess their compensation arrangements and address all material conflicts that arise from such arrangements. Firms should be able to demonstrate that product shelf development and client recommendations are based on the quality of the security without being influenced by third-party compensation. For example, we have seen a control in place where the CCO must approve all the registered individuals' recommendations. With this control in place, the firm is taking steps to ensure that the registered individuals are not choosing securities that provide a higher third-party compensation, and all trades are assessed for suitability in the best interest of the client. We have also observed firms that engage in independent third-party experts who are compensated independently from sales or product approval as part of their product review committee. However, for PM firms, care must be taken to ensure that only registered advising representatives are involved in making portfolio management decisions for the firm. A material conflict also arises when a firm creates incentives for registered individuals to sell or recommend certain products over others. Sales and revenue targets are almost always a material conflict of interest between the registered individual and clients, because such targets can cause a registered individual to put their interests ahead of the client's interests. Therefore, in most cases, we have seen firms avoid this conflict of interest altogether. We have also observed firms that have taken steps to ensure their compliance staff is compensated in a sales mutual manner. For instance, they are salary-based. This will ensure their oversight of suitability and conflicts of interest is not impacted by the choice of product or sales volume. Fee-based accounts that hold securities with embedded commissions are almost always a material conflict of interest. Firms should have controls in place to confirm that clients are receiving services consistent with the terms of the account or agreement with the clients. As mentioned previously, we expect firms to assess the impact of the costs on the client's account, and firms must avoid double charging clients. For example, if they have a fee-based account that holds a proprietary fund that charges a management fee. There is also an inherent conflict of interest for paid referral arrangements. These are almost always a material conflict of interest. In making a referral, firms and registered individuals must be guided only by the client's interests. If a client pays more for the same or substantially similar products or services as a result of a referral arrangement, this would be a material conflict of interest that the firm is required to address in the best interest of the client. If there is no referral arrangement and a client pays more for the same or substantially similar products or services when compared to others, there may be a material conflict of interest, and there is always the potential for a breach of the registrant's duty of care owed to clients. For example, we have seen firms charge different spreads, resulting in some clients receiving a higher interest rate for their investment when compared to other clients who purchase the same or similar security. We expect the firm to demonstrate how it has addressed any such material conflict of interest and acted in the best interest of its clients when giving a higher rate of return or a lower fee to some clients. In this example, the firm can establish and disclose criteria for when someone can get a higher interest rate. For example, based on the size of the account, type of the account, and the nature of the firm's relationship with its clients. If the firm cannot address the conflict in the best interest of the client, then the conflict must be avoided. The CFRs have led to a change in a firm's RDI obligations. I will cover the changes to the RDI obligations with respect to proprietary products and costs, fees, and charges in certain contexts as outlined in this slide and the next few slides. I'll also cover RDI obligations with respect to limits on a client's ability to liquidate or redeem a security, as I think both clients and firms could benefit from meaningful disclosure in this respect. The CFRs introduce a definition of what is a proprietary product, which means related and connected issuers, as well as investment funds managed or advised by the firm or an affiliate in their capacity as an investment manager or portfolio manager. Firms must provide clear disclosure of the nature of the products and services they are offering, including disclosure of any limits on the products and services that are offered to clients, including whether proprietary products will be primarily or exclusively offered. For example, we have seen firms disclose all related and connected issuer products. We have also seen firms disclose the related or affiliated portfolio managers and investment fund managers that are managing the security being sold to or traded for the client. With respect to limits on the availability of products or services offered, this would include limits by registration category. For example, exempt products only for exempt market dealers and restricted investments for restricted portfolio managers, such as mortgage products and oil and gas investments. In order to provide transparency and set client expectations, the firm must disclose whether non-proprietary products will be offered through the firm. The CFRs for RDI require firms to disclose restrictions on the client's ability to liquidate or resell a security. For exempt market products and pool funds, this would include disclosure of there being no secondary market for trading. We also expect firms to outline time and restrictions on a client's ability to liquidate or resell securities. This includes minimum hold periods, the frequency of redemption periods or windows, and any advance notice required by clients when requesting a redemption. For example, 30 or 60 days notice. Disclosure of monetary restrictions would include cash redemption limits and/or the issuance of promissory notes in lieu of cash redemptions. In such cases, we expect that firms will also consider whether this redemption feature may have a suitability impact for clients who have a registered account with the firm. Further, penalties for redeeming securities early should be disclosed, including situations in which the redemption price or net asset value is discounted for early redemption. We recognize that the RDI is typically provided at account opening and prior to the client subscribing to a product, at which point exact product liquidity or redemption features may not be known. However, based on the approved products on the firm's product shelf, we expect that firms will have a general idea of liquidity and redemption limits. As such, at minimum, we expect a general description of market, timing, and monetary restrictions for the types of securities offered by the firm. The CFRs introduced new disclosure requirements regarding costs, charges, and fees. Firms continue to be required to provide disclosure about certain charges they may charge directly to the client. For instance, firms are still required to disclose operating charges that the client might be required to pay related to their account. For example, account management fees, annual account maintenance fees, withdrawal fees, and transfer fees. Firms are also required to disclose a description of the types of transaction charges that may apply, such as spreads and commissions. In addition to the pre-CFR requirements, firms now must provide general disclosure of investment fund management fees and other ongoing fees that are applicable to the securities or services that the firm provides, and any monetary and non-monetary benefits that the firm will receive or may receive as a result of the client owning or purchasing a security from a person other than the client. This captures third-party compensation, such as trailing commissions and issuer commissions, including options and warrants. Another new requirement is that firms must provide an account-level, not security-specific, general explanation of how the investment fund management fees and other ongoing fees, operating charges on the client's account, and transaction charges the client might be required to pay could potentially impact the client's investment returns and how this impact compounds over time. Firms must use professional judgment in preparing this information, but CSA staff do not think that generic summaries of fees applicable will be sufficient to meet this requirement. As an example, firms can meet this requirement by including an account-level example of how a 2% management fee and a 20% performance fee above a high water mark would have impacted a client's return if they had invested $10,000 over 10 years in a composite of the types of securities offered by the firm, if past performance is available. When past performance is not available, firms could perform the same calculation using a benchmark that is reasonably relevant and comparable to the securities offered by the firm. The RDI requirements include disclosure of conflicts of interest. While this requirement is not new under the CFRs, firms must consider the amendments in relation to how conflicts of interest are addressed when providing disclosure. As mentioned earlier, disclosure of material conflicts alone does not suffice. Material conflicts must be either avoided or addressed in the best interest of the client. How the firm has addressed the conflict of interest must be disclosed. The firm must also disclose the nature and extent of the conflict of interest and the potential impact on and risk that the conflict of interest could pose to the client. With respect to conflicts in relation to proprietary products, disclosure should include the firm's relationship with related and connected issuers and products and how the relationship may lead to a material conflict, whether non-proprietary products are offered through the firm or a mix of proprietary and non-proprietary products are offered. If only proprietary products are offered, firms should consider disclosing the impact of this decision to investor. As an example, firms can disclose that in determining suitability, the firm and its representatives will not consider the market of non-proprietary products or whether those non-proprietary products will be better, worse, or equal in meeting the client's investment needs and objectives. Compensation arrangements such as upfront trailing commissions or other incentives that may lead to dealing representatives or advising representatives selecting proprietary products over non-proprietary products for clients should be disclosed. As this is a material conflict, firms must disclose how this conflict has been addressed in the best interest of the client. In relation to distributing proprietary products, the costs, charges, and fees are a key consideration in relation to how this material conflict of interest is being addressed by the firm and how the firm has adopted adequate controls for the conflict. As this is a key aspect in demonstrating that the material conflict has been addressed in the best interest of the client, we expect that all firms that have proprietary products will be providing product-specific disclosure of all direct and indirect costs, charges, and fees that are applicable to the proprietary product they are recommending or trading for the client. Finally, I would like to briefly cover the rest of the RDI amendments. Firms are required to amend their RDI disclosure about the suitability determination to disclose the new requirements applicable to all investment actions and how they are required to put the client's interest first when making a suitability determination. The wording stating the requirement to provide clients with KYC information collected by the firm was amended to clarify that this means providing the client with KYC information the firm has collected. More specifically, a copy of the KYC information collected at account opening and during KYC updates. Firms are expected to also provide an explanation of various terms, such as risk profile used in the KYC form. CFRs introduced a new section for misleading communications, specifically the new holding out and title restrictions. In the new restrictions on holding out, registered individuals and registered firms must not hold themselves out in a misleading manner in respect of their proficiency, experience, qualifications, or category of registration, relationship or potential relationship with the client, or products and services provided by the firm. Certain titles can be confusing or misleading to an investor, or imply that a registered individual performs a particular function at a firm or has particular expertise. For example, it is misleading when a registered individual uses the title wealth advisor when the individual is not registered as an advising representative of a PM. Further, it can be misleading when a firm misrepresents the products and services available, as well as the nature of the relationship that may exist between the firm and the client. Another example we have seen is in situations where an EMD will hold itself as having a fiduciary duty to its clients. Another example where it could be misleading to a client is when a firm holds themselves out as a firm that offers a wide range of products, but it only offers proprietary products. In the requirements relating to titles, registered individuals who interact with clients must not use titles, designations, awards, or recognitions based on sales activities. It can be misleading when a registered individual's title, designation, award, or recognition is tied to their sales activities. For example, it can be misleading when a registered individual uses awards like President's Club, because these awards are based on the registered individual sales activities. Further, a registered individual cannot use corporate office titles such as vice president or director, unless the firm has appointed the registered individual to that corporate office pursuant to corporate law. The firm must consider whether the use of corporate office title would be misleading prior to approving their use. Lastly, a registered individual cannot use titles or designations unless they have been approved by the firm. Firms should have controls in place to verify that designations claimed by registered individuals are from reputable institutions that follow verifiable accreditation criteria. A higher level of due diligence may be required for designations that are not well known. Firms should also verify that designations have been awarded to the individual and individuals are in good standing with the institution issuing the designations. This can often be achieved by checking the designating body's public database if available. Here are the rules and guidance that we use today in our presentation. As our compliance examinations identify new practices related to the CFRs, we expect that new CSA guidance will be published in the coming years. We recommend you keep an eye on future updates from the ASC and CSA. We hope the material we presented will help you. Thank you for attending the presentation today.